Dividend ETFs. If you're watching this video, then I can already assume that you know what those words mean. And while the rest of the world is crashing and burning, you're poising yourself to be in an advantageous position in the upcoming year. Or you're just looking for another way to make good passive income, and I respect that. So in this video today, we'll be breaking down the only dividend ETFs that you'll need in 2023 that'll provide high dividend yields and high annualized growth to get to where you want to be wealth-wise. And before we start, a huge shout out to Ekster for being the sponsor of this video, but more on them later. So with the intros out of the way, let's talk about dividend number one, and that's the Wisdom Tree US High Dividend Fund, or DHS for short. Currently trading at $86.62, the Wisdom Tree US High Dividend Fund's goals are to gain targeted exposure to US equity from high dividend yielding companies. DHS can be used to complement or replace large cap value and dividend oriented active and passive strategies, or be used to satisfy demand for a growth potential and income focus. Again, DHS is currently trading at $86.62 and has an expense ratio of 0.38%, meaning for every $10,000 invested into this dividend ETF, you'll pay just $38 in fees for things like general upkeep, marketing, and management. Pulling up DHS's max chart, I think this is where this dividend ETF towers over the rest. While the entire stock market has entered bear territory, DHS has a YTD daily total return of a positive 9.04%, a 1-year daily total return of a positive 14.05%, and a 3-year daily total return of a positive 8.75%. The only dividend ETF out of the 5 that I'm talking about today that scored 3 for 3 in positive return metrics. And pulling up their max chart, it has tripled in value since 2009, 14 years ago, meaning that if you were to invest $10,000 into this ETF 13 years ago, that $10,000 nest egg would have turned into a $30,000 nest egg today. On top of its high growth every single year, DHS also has a pretty decent dividend yield of 3.32%. So again, for every $10,000 you invest into DHS, you're getting roughly $332 in dividends annually, or roughly $28 monthly. Out of the 311 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as ExxonMobil, the oil giant with 8.34%, Chevron, the other oil giant with 5.67%, and ABBVIE, the pharmaceutical giant with 5.09%. DHS encompasses most sectors, but the top 3 sectors that it currently holds are with healthcare with 21.4%, energy with 20.36%, and consumer staples with 17.73%, and has a total net asset valued at just a little over $1.31 billion. So just to recap what DHS is all about, it has $1.31 billion in total net assets and a dividend yield of 3.32%. It's currently trading at $86.62 at the time of recording this video and has tripled in value since its inception 14 years ago. Alright, let's talk about dividend ETF number 2, and that's none other than the Schwab US Dividend Equity ETF, or SCHD for short. Currently trading at $76.01, the Schwab US Dividend Equity ETF's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. The fund can serve as a core or complement a diversified portfolio, and invest in stocks selected for fundamental strength relative to their peers based on financial ratios. SCHD is currently trading at $76.01 with an extremely low expense ratio of 0.06%, meaning for every $10,000 you invest into this dividend ETF, you'll pay just $6 in fees for things like general upkeep, marketing, and management. And pulling up their max chart, it has tripled in value since its inception in 2011, 11 years ago, meaning that if you were to have invested $10,000 into this ETF 10 years ago, that $10,000 nest egg would have turned into a $30,000 nest egg today. Taking a look at its performances over the last 11 years, it currently has a negative 2.64% YTD daily total return, a 1.62% 1-year daily total return, and a 13.95% for its 3-year daily total return. And taking a look at SCHD's annual total return history, SCHD has only 2 years since its inception where it entered bear territory, and those years were in 2018 and 2015. Other than that, it's had consistent increases year over year of about 20%, which makes it one of the best ETFs that you could possibly get in the market today. On top of its high growth every single year, SCHD also has a pretty decent dividend yield of 3.36%. So again, for every $10,000 you invest into SCHD, you'll get roughly $336 in dividends annually, or roughly $28 monthly. Out of the 103 companies that it currently holds within its top 10 are companies that everyone has heard of, such as Merck & Company, the pharmaceutical company, Home Depot, the home improvement retail corporation, or Pepsi, the beverage company. SCHD encompasses most sectors, but the top 3 sectors that it currently holds are with information technology at 21%, financials at 20.51%, and consumer staples with 14%, and has a total net asset valued at just a little over $44 billion. So just to recap what SCHD is all about, it follows the Dow Jones US Dividend 100 Index. It has $44 billion in total net assets and a dividend yield of 3.36%. It's currently trading at $76.01 at the time of recording this video, and also has tripled in value since its inception in 2011. Before we continue, I just wanted to take a moment and talk about Ekster wallets. Ekster offers wallets of all preferences and sizes, with their slimmest wallets being the card holder line, which holds up to 12 plus cards, or the modular bifold line, which offers the classic old school look with a modern touch of being able to take off the card sleeve whenever you're looking for even more mobility. Did I mention that they even have wallets that are customizable for AirTags as well, or an 18-karat gold card holder for the bougiest credit card veterans in the credit card world? Whatever your preferences are, there's definitely an Ekster product out there that will definitely fit your style. And they're currently having their biggest holiday sale of the year, so you should definitely go on their website and check them out. I'm talking about up to 45% off your next Ekster wallet, and when you use my personal code ERICGAL at checkout, or with the link down in the descriptions down below, you'll get an additional 5% off your next product. Thank you again to Ekster for sponsoring this video. Find a wallet with Ekster that you'll definitely want to show off this holiday season. Alright, let's talk about Dividend ETF number 3, and that's an Amplified CWP Enhanced Dividend Income ETF, or DIVO for short. DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth, along with a tactical covered call strategy on individual stocks. DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. DIVO is currently trading at $36.07 per share with a semi-high expense ratio of 0.55%, meaning for every $10,000 you invest in this company, you'll be paying $55 in expenses for things like general upkeep, marketing, and management. And pulling up DIVO's max chart, if you were to have invested $10,000 into DIVO when it was first launched in 2016, your $10,000 nest egg right now would have grown into a $15,000 nest egg. Pulling up DIVO's performances over the past 6 years, it has a YTD daily total return of negative 1.39%, a 1-year daily total return of 0.66%, and a 3-year daily total return of 11.52%. And taking a look at DIVO's annual total return history, DIVO has only had 1 year since its inception where it entered bear territory, and that year was in 2018. Other than that, it's had consistent increases year over year. On top of its high growth every single year, DIVO has a great dividend yield of 4.86% annually, which makes it both a strong contender for passive income and high annualized growth. Definitely a dividend ETF that everyone should own. And again, for every $10,000 you invest into DIVO, you'll get roughly $486 in dividends annually, or roughly $40 monthly. Out of the 24 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as United Health Group with 6.23%, Chevron with 5.48%, and McDonald's with 5.18%. DIVO encompasses most sectors, but the top 3 sectors that it currently holds are with healthcare with 18%, information technology with 17%, and energy with 13%, and has a total net asset valued at just a little over $2 billion. So just to recap what DIVO is all about, it has over $2 billion in total net assets and a dividend yield of 4.86%. It's currently trading at $36.48 at the time of recording this video, and has jumped 50% since its inception in 2016. Dividend ETF number 4 is none other than JEPI, or the JP Morgan Equity Premium Income ETF. This ETF primarily focuses on stocks from the S&P 500 with a curated algorithm to identify value stocks with low risk and good returns, and its overall goal is to deliver monthly distributable income and equity market exposure with less volatility. JEPI is currently trading at $55.88 per share with an extremely low expense ratio of 0.35%, meaning for a $10,000 investment, you'll only be paying $35 in expenses for things like general upkeep, marketing, and management. And pulling up JEPI's max chart, if you were to have invested $10,000 into JEPI when it was first launched in May of 2020, your $10,000 nest egg would have grown into $12,000 nest egg over the course of the past 2 years. Taking a look at its performances over the last 2 years, it currently has a negative 2.66% YTD daily total return, 0.31% 1-year daily total return, and 0% for its 3-year daily total return. Well, that's because it hasn't even been around for 3 years yet. And taking a look at JEPI's annual total return history, it doesn't really have one because it's only been inception for 2 years, but it does have data for 2021 where it recorded an impressive 21.61%. On top of this high growth every single year, JEPI has an insane dividend yield of 10.6% annually, which makes it a strong contender for passive income, but accommodating its high growth in 2021, it's definitely a core ETF that everyone should own. So again, for every $10,000 you invest in a JEPI, you'll get roughly $1,000 in dividends annually, or $88 monthly. Out of the 125 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as Exxon, the oil giant, Pepsi and Coca-Cola, the beverage companies, and United Health Group. JEPI encompasses most sectors, but the top 3 sectors that it currently holds are with industrials at 12.8%, healthcare at 12.1%, and consumer staples at 11.6%, and has a total net asset valued at just a little over $14 billion. So just to recap what JEPI is all about, it follows the S&P 500 index pretty closely and mixes in some out-of-the-money covered calls to make up a majority of those monthly incomes. It has $14 billion in total net asset and has a high dividend yield of 10.6% and is currently trading at $55.88 at the time of recording this video. And finally, last but not least, the last dividend ETF that we'll be talking about today is the JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ for short. JEPQ generates income through a combination of selling options and investing in US large cap growth stocks, and primarily focuses on stocks within the Nasdaq 100 index and constructs a long equity portfolio through a proprietary data science driver investment approach designed to drive portfolio allocations while maximizing risk-adjusted expected returns. JEPQ is currently trading at $43.15 per share with a low expense ratio of 0.35%, meaning for a $10,000 investment, you'll only be paying $35 in expenses for things like general upkeep, marketing, and management. And unfortunately, we're not going to be taking a look at its performances over the past couple of years because this ETF was actually created May of 2022. What's appealing about JEPQ and JEPI is that they both have extremely high dividend yields. And JEPQ actually has an even higher dividend yield than JEPI does, netting an insane 15.89% dividend yield. So again, for every $10,000 you invest into JEPQ, you'll be getting roughly $1,600 in dividend yields annually, or roughly $132 monthly. Out of the 84 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as Apple, Microsoft, Google, and Amazon. JEPQ encompasses most sectors, but the top 3 sectors that it currently holds are with information technology at 40%, other at 18%, and communication services at 11.5%, and has a total net asset valued at just a little over $603 million. So just to recap what JEPQ is all about, it covers mostly the Nasdaq 100 index and mixes in, just like JEPI does, out of the money covered calls to make that monthly dividend income. It has $603 million in total net assets and an insanely high dividend yield of 15.89%. And it's currently trading at $43.15 at the time of recording this video. Alright, I've just showed you the only dividend ETFs that you'll need to invest in 2023 to put yourself in a winning position in the following years. What I find most interesting about JEPI, JEPQ, or DIVO is that they primarily make monthly dividend income from out-of-the-money covered calls, similar to the wheel strategy that I personally use that was popularized over the last 2 years. So as long as the market continues to be a little neutral or slightly bearish, these types of ETFs will continue to pump out these insane high dividend yields. For those of you out there that are new to the channel, Hi, my name is Eric. I generally talk about everything credit card related, but more recently I've been making videos on broader financial topics such as these videos right here. The main goal for this channel is to provide informational and meaningful financial related content that everybody everywhere can enjoy. So again, if you'd like to support that dream, make sure to hit that subscribe button. And with that, thank you for watching as always. Until next time everybody, stay safe out there. Peace.